All right, good evening. This is Ken from Tortoise Capital with a review of the weekend trading report for September 21st, 2013. I'm recording the whole session tonight. Sonny, I'll send me an email to longke@yahoo.com and I'll send you some subscriber information. Thanks for your interest. longke@yahoo.com. So we've got Sonny, yes, that's correct. We have a market that's in bullish normal conditions. On an annual basis, we're at 66 out of 100 using the weekly RSI 14. And on a 10-day basis, using the 10-day NDX, we're at the high end of normal with 69 out of 100. So both of them are in the middle of the indicator range. Looking at the market mosaic, price relative to the 200-day moving average is still yellow bullish at 8.30%, so a slight increase for the week. Slope of the 50-day moving average decayed a little bit this week, and it's yellow neutral at 0.32%. ADX increased to 21.0, so still in the neutral, but bulls getting slightly more traction in terms of trendiness. ATR percentage declined to 0.87% at the lower end of normal. The risk index, which is the 30-period moving average of the VIX divided by the 10-period moving average of the VIX, is at 1.06. So this week we shifted back into risk on conditions. That score of 1.06 has a z-score of positive 0.71. So if we look back 5,000 days and found all the statistics about that risk index, this would come in at a z-score of 0.71. And this is the 90-day time series on that risk index, and you see it after a period of volatility, it's been decaying. And this has been good for XIV, the inverse of the VXX. It's had a good swing trade, and we'll take a look at that one later. Looking at the blended monthly rebalancing, no change to any of the holdings. The next reevaluation is due on or about 1 October. So they're still holding healthcare, tech, and consumer discretionary. The 13 ETF portfolio has a scoop of small caps, a scoop of tech, and 1 scoop of cash. In ETF 2, the theoretical model is at 100%. The model portfolio is at 100%. So no change there. Excuse me. We'll take a look at some ETF blended monthly rebalancing portfolios now, just to see what's working in the world. Most of the 13 ETF portfolio is on a buy position. The top 3 are technologies, U.S. small caps, EFA. The Euro-Asia blend is still better than the S&P, and that's continuing, I think, that's about 4 weeks now. We've seen that shift in strength away from the U.S. and back towards the globals, and Japan is still doing well. So S&P, which had been the strongest for a long period of time this year, is back in the middle of the pack. Only U.S. real estate and treasuries are in cash positions. If we now look at the 32 ETF portfolio, most of that is also on buy signals. Excuse me. China is at the top, followed by the U.S. techs, and then the BRIC ETF, EEB, that's Brazil, Russia, India, China, has had a really nice rebound over the last 3 months. And then Europe, IEV, that's the European 350, that's the Europe's equivalent of the S&P 500, has also turned in a really strong 3-month period. And just by comparison, the EFA is at 10.21%, and the spiders are down here at 5%. So we're seeing a real shift to Euro-Asia. I've added this one, the ETF Max. I think it's like page 4. No, I'm sorry, page 3 in your weekend report. And this is, from the 1,500 ETFs that are available, and just to see what's really working. And the solar ETF TAN, and this is that the Chinese ETF, that one that should do very well from the change in Chinese policies, PGJ, has been up 31% last 3 months and 50% in the last 6 months. So this just gives you an idea of what's really working out there. The U.S. biotechs are still doing really well. Here's the S&P biotechs, Market Vectors biotech, NASDAQ biotech. Clean energy and Wilder Hill Clean and alternative energy doing really well. This Chindia is kind of interesting, the FNI. That's that mix of China and India. So hopefully that'll generate a few additional ideas for you by including the ETF Max. I'm going to shift to the market health check next. Excuse me. Okay, the market health check. The vertical blue lines represent 10, 20, 30-day look-back periods. And each blue line is an additional 10-day segment. Horizontal purple line is the current swing high at about 173 and some change. Made a new high on Thursday after the Federal Market Federal Open Market Commission comments, and then a harsh sell-off in that afternoon, then all day Friday. The horizontal red lines represent support levels that have held in the past and should continue to support. The dark shaded blue area is the 30-period Bollinger Band, plus or minus 1 standard deviation, or the river. The light blue shaded area is plus or minus 2 standard deviations on the 30-period Bollinger Band. That's the floodplain. The red shaded area in the middle is the dragon. That's the 10-period Bollinger Band, plus or minus a half. That acts as sort of a noise filter for price and acts as support and resistance during the ebb and flow of the swing trade. Thick blue lines represent a 10-period RAF regression channel. You see how steep up that is sloping. And the center line is the regression line itself, and the outer channel is the maximum excursion from the regression line during the look-back period. That gives you the bounds of normal over that look-back period given the RAF regression theory. The black line and channel is the 30-period RAF regression channel lagged by 1 day. And then the dark green is the 90-period RAF regression channel. We have 90 days represented here on the chart. And so what you have is the longer-term trend, the green line, is still up, and we're in the upper half of that upward trend, so that's positive. The 30-period, or the middle trend, has reversed from sloping down to sloping up, and we're right near the top of that, but in the upper half, at the 3/4 mark, if you will. And that's positive. And then the blue is sloping up, although we've pulled back based on Friday's price sell-off. Now, the slope of the 30-period moving average is reflected by this thin black line. And what I've highlighted in blue are key turning points in the slope of that 30-day regression line. You know that, in my view, that the 30-day period is an important one, and the 30-period regression line is a very useful indicator for intermediate-term strength and direction. Now, what this chart reflects is this dotted line in the middle is the zero line. If you look on the left-hand side, the left-hand y-axis, the zero line. Anytime that thin black line is above that zero line, then the slope of this 30-period regression line is up. So you can see right now it crossed that line about on Monday of last week and has been steadily improving since then, part of that upward trend. The last time that it reversed, it was down here at about minus 0.225, and that was as steep downward as it has been since late June. And what I want you to notice is that when that regression line slope I don't understand your comment there, Martin. I see the full screen. There's 90 full days on there. When that regression line slope gets as steep downward as it can, and then can no longer get any steeper, like around minus 0.225, you'll notice that that marks an important intermediate turning point in every case. Back at the end of June, and that turning point happens fairly quickly, usually within 5 days, and then it reorients you to potential reversals of trend in time to do something about it. And in fact, the reversal happened right as back in June happened right as price was inside the dragon, right at the southern edge of the river, and then this excursion out turned out to be a really nice entry point. 3 or 4 days later, that slope of the regression line had improved to where it crossed the zero line in this next blue circle, and then it got as steep up as it could get, and then started to decay once more once it got up around plus 0.45. And then that rollover anticipated a pretty steep downward decline in price, which was reflected in the slope down, and it crossed the zero line once more right here, back when the market was flat. Then the downward slope again got to about minus 0.225, reversed once more, and crossed the zero line here last week, and is now sloping upward, and as high as it's ever gotten is 0.45. So I think that's a pretty handy indicator to talk about where the market is in terms of its life cycle. Yeah, you can see ADX has now started to increase. It got below, or got right down to 15, and now starting to slope upward with bulls in charge. So once we get above 25, we would say that the bull is definitely back. And because we have this close above the previous swing high, which was around 171 and some around 171, I think we certainly can make the case for an upwardly moving market with strength shifting to the globals here, based on the fact that the Fed is still willing to print money without resting. I see us needing to get above 173 into the green zone here to be a resumption of that bull. The yellow zone I'm looking at between 173 and 170. This is that tactical noise area where we've got to be very adept. If it fails back below 170, then it will have rejected that new high and will have violated the support level that was the previous swing high. And then, so I see price right here about 170 being really key support. And then the downside targets being at 168, 167, then 163, down around the bottom of the 30-period regression channel. We can see the 200-period moving average has crept back on here, back onto the chart. We haven't seen that one for a while. We're coming out of on the Williams percent R10, coming out of an extended period of overbought, and that's consistent with the resumption of the bull. So this is really very bullish, and the hypothesis is that it holds at 170 and resumes. That makes this pullback on Friday an opportunity to buy some more. But again, I want to see it hold around 170 to really be convincing. If the slope of this 30-period moving average or 30-period regression line were to get all the way back up to where it was before at 0.45, then we'd see another leg up here to about, that would take us up to about almost 180 in order for the slope of this regression line to continue to be that strong. So there's, $5 or $6 to the upside. There's still that much room available. That would make the ADX climb up above 25 and then become an obvious powerful trend. The only thing even working against that hypothesis is that horrible selling on Friday. That selling on Friday basically erased all of the surprise Fed announcement. We'll see that when we look at the charts of interest. So that's the market health check. We got the bull got a shot of adrenaline this week from the Fed. Looking at the ETF 2 database and the 10 regions of the world in that model is up next. All 10 of the regions are on a buy signal. They're all above their 4-month moving average. That puts the portfolio model at 100% invested, same as last week. Right now, EFA is doing better than S&P. EFA has a strength score of 64. The S&P has a strength score of 60. IEV is very strong here at 66. I should have reflected that here in the strongest sectors down here. So the real strength is in Europe. In that Euro-Asia blend, it's Europe right now that's dominating. Inside the U.S., it's technology at 65, small caps at 64, mid caps at 61, followed by the large caps at 60. This should read the two strongest sectors are IEV at 66 and then U.S. tech at 65. Two weakest remain Latin America at 57 and looks like Japan at 60. And a tiebreaker with the U.S. there, S&P. So how the mighty have fallen. S&P was the strongest for a long period of time out of all 10, and now it's back down to number 9 out of 10. Inside the U.S. sector spiders, strength is in consumer discretionary XLY and industrials at 63 here. And materials at 62, healthcare at 62. The two weakest, consumer staples and utilities, so the conservative posture. are still weak. Looking at the world market model, for the first time, we've actually seen some weakness creep into the U.S. inside the Dow. Probably a function of the rebalancing. The daily and weekly reports going forward now will reflect those three new holdings in the Dow. This last weekend's report was the last one that will include the old timers like Alcoa and Hewlett Packard, which are falling off, which is too bad because those are two of my preferred trading targets, so we'll have to find some new ones. As you can see, the strength in South Korea and China. All of Asia and Japan and Asia less Japan are above average. Everything Europe is very strong. No weakness in Europe at all. Canada, Mexico, Brazil have resumed their above average plays. And Brazil is catching up to the U.S. pretty nicely here. The alternate asset classes, only oil remains above average. All the commodities, however, are continuing to suffer. The global business sectors are starting to dominate their U.S. counterparts now. As you can see in every case, the global sector is doing better than the U.S., except in cases where there's ties. Materials and energy are a tie. But otherwise, it's the global, except for healthcare, which is still pretty close. Looking at the currencies, it's now the yen is in that area of weakness with respect to the U.S. dollar, and the weakness in the Australian dollar seems to have been smoothed over and had a nice rebound this past week. Now that weakness has shifted to the yen. ETF top 30. The solar ETF TAN is still up there. Biotechs, clean energy, Spain, more biotech, Italy, South Korea, Netherlands, Sweden, China, France. Look at all the shift now going on to the globals. More China, Poland, Russell 2000 growth. So all of those conservative U.S. large caps have been falling off, and this is looking like a sea change in the market here. Next up, inside the Dow 30 through the same lens. And strength in Boeing, United Tech, United Health, DuPont, Bank of America. And let's see, Hewlett Packard is going to fall off the report this week. So the leaders remain the leaders among the Dow. Going to shift now to the weekend or the daily report for Monday, based on Friday's closing data. And again, take note of the of any symbols that you'd like to like me to look at when we get to the charts of interest. We have no signals in overreaction or channeling. We've got channeling and overreaction for Hewlett Packard and United Health. You can see that the volatility is in the low range of normal, and that the ADX is increasing with bulls in charge. Oil is on channeling. The VIX, United Health, and oil are positive on the auto framer. But that's generally going to happen, a scarcity of the framed signals whenever we have a close that's near that 10-day high, because it's hard to find 2-to-1s using that as the standard frame of reference. And you can see that reflected in the Dow tactical summary What's of interest in the Dow Tactical? Let me let that come up on your screen there. Four symbols that are that are firing on RSI2 in single digits, and that would be Hewlett Packard, United Health, Caterpillar, and Disney, all in single digits for RSI2. Caterpillar is of interest given its 1 and 10-day weaknesses. It's single-digit RSI2. It's number 3 on your max pain range compression. But really not much else to pick from, except I would take a look at Boeing here. It was the number 1 on the strength report for the Dow, but it was a percent loser on Friday. And if you take a look at its relative performance over the last time periods, it's in the red for 1 day, but otherwise it's been the leader in the Dow over 10 days, 30 days, 3 months, 6 months, and 12 months. So that could be a nice 1 day pullback to find Boeing on sale. And if you're a believer in relative strength, that's one that would certainly be attractive. Shifting to the ETF 30, let's see what we got. Again, not much to choose from here, although we have 2 now that fire on the auto framer. The VIX at 5.3 to 1 is also number 1 max pain range compression, and oil is at 2.1 on the auto framer. Otherwise, nothing else to choose from RSI2 or any signals except for that lone channeling signal in oil. So we should be looking at oil, the VIX, and therefore XIV. We'll look at Caterpillar and Boeing for sure. Here are the stats on from the auto framer. I'll just let you glance at those. Only 3 fire there. That's the VIX, United Health, and oil. All at better than 2 to 1, based on mechanical entry and a retest of the 10-day high. Looking at some more market mosaic indicators now. Chart number 1 is that 30-day regression line slope of the S&P. The blue line is the straight regression line. The black line is a polynomial regression, which gives you an acceleration factor. And so this was basically 1 day of warning on Friday, that sharp sell-off. It's still above the regression line, so it's not in danger yet. But that is the first sign of weakness we've seen in that for a while. You can see the slope of the regression line in chart 4 is still above its 10-period moving average. It's back now to the 6-month average, which is slightly up. And you can see how that thing has also made 4 standard deviation oscillations, 1, 2, 3 times, and now has bounced 2 standard deviations off its previous low, and that has been, about a 5 or 6% move in the S&P. And standard deviation of price as a measure of volatility and the ATR percentage as a measure of volatility, both are right in the center line of their respective averages over the last 6 months. So volatility is currently at normal levels, we would say. Nothing unusual there. I'm just going to flash through the reference data here. When we look at the slopes of the regression lines normalized for their standard deviations over the last 6 months, on the top chart here, we're looking at the 90 in red has reversed and starting to slope upwards again. That's still very positive. That's the long-term trend. The 30 bounced off its low down here at -1 sigma and has now crossed to the upside. The 10 period put in a nice move and then retraced on Friday, but we're still very positive here. This is a buy on dip opportunity. Price at the upper edge of the river, as you can see on the southern chart. So We would think in a bull market that it would hold here. I would point out that the last two times that it's tested that, where it came out of the river and then pulled back, it failed for 5 to 8%, and over here it failed for 5 to 8%. The two previous times before that, it failed and went to the bottom of the river. So if it did that, that would represent a pretty significant pullback. So let's see what this bull is made of here, and see where it's going to find its support level. We'll just recognize that we'd be looking at a return to the middle of the river and the south side of the river as both pieces of evidence that this would hold. And it'd be nice if it could hold here at 170 at the north end of the river, but we'll see. So just be alert to the downside possibilities. And that's everything I want to cover on those charts. We're going to shift to charts of interest next. Excuse me. Okay, so we have we're just taking a quick look at the Dow because that got harshed more than the S&P did on Friday. This was this move inside Wednesday was the sharp response to the Fed, followed by a little bit of sell-off on Thursday, and then harsh selling. And as you can see, it sold off all of the Fed bounce and then some, and is now right at the north edge of the river, where the dragon has moved from the south side of the river out of the congestion zone all the way through the river now to the upside. And so this is really an important price level on DIA right here. And we'll shift and take a look at the S&P. We're going to see approximately the same thing. Yeah, you can see basically the same thing here in the S&P. Holding at the just above the north edge of the river in the floodplain, gave back all the gains from the Fed surprise. The dragon has moved all the way across the river and is at the north edge, and price has re-entered. So this is a really important support level here. This is a this little sine wave. We're going to see if it holds here or if it fails. If it fails here, then we would expect 167. The Bollinger Band mean is the next logical target on the downside. So we could see failure here at the edge of the river, failing out of the dragon, and then failure to the Bollinger Band mean, and then failure to the downside of the southern side of the river. Failure out of the river would constitute real failure in my view, because it puts this entire move. It erases that entire move from 163 to 173, which is 10 points, about a 6% move. All right, so let's see if we can take a look at some individual symbols of interest. Take a look at Boeing real quick. This was at number one in the excuse me, number one in the Dow, and among the strongest symbols around the world. After that long period of, let me wait for that to come up for you. Long period of sideways quiet channel and the breakout around 106 all the way up to 120. And now that pullback, again, this is a one-day sharp pullback. That was a huge sell-off compared to its peers in the Dow. But on the upside, it's nowhere near the southern edge of the river. It just now came back into the floodplain. And so that's either going to be a nice buy on dip opportunity for a relative strength leader. You can buy it on 5% sale, or it's going to be more weakness and looking to get back to the edge of the river at 112, or at the Bollinger Band mean at 107. All right, so let's take a look at oil, USO. Oil is in a nice position for trading. This powerful oscillation going on. It's back to where it held support the 3 previous times at the southern edge of the river. Held support strong at 37.60, closed near the bottom of its range. If it takes out 38.20, you can see that there's two units of reward to the upside, but failure here below that low at 37.60 sends it down to 37 even. So you have a nice critical state right here, ready to go in either direction with a favorable reward to risk ratio. So that makes USO a very interesting trade. Let's try UNH, United Healthcare. This was another relative strength leader. Only this one looks really harsh compared to Boeing. It's suffered 4 days in a row of major fails, and so this entire sideways quiet channel and upward excursion is gone. Oh, let me let that come up. Yeah, so this puts the entire UNH move at risk. It either finds last gasp support here around 70.80, or it's on downward to 67, down in this area, to start closing this gap. That's the reward on the downside. This is the reward on the upside. So UNH is in a very critical state. This is a nice location for a swing trader that is adept. We'll take a look at TLT next. Treasuries have put in a nice 30% pullback from the previous swing high. If we're looking at this on this is your risk-free rate of return in the U.S. Treasuries, right? From 124 down to 102. Actually, that's 20. That's about a 20% loss. The long-term. This is the 200-period moving average. That's the long-term downtrend. You can see the river has gone down, but on the positive side, we can say that we've got a double bottom put in. Strong support here at 102. So if you can buy it with a $3 stop, what you have to be able to see is 110 a reasonable swing target? Sure. It has to get through some support and resistance here at 106.5, 107.5 en route to 110. But the last 30 days look more like sideways oscillations than it does the big down arrow. So that would be consistent with putting in a bottom here. Let's take a look at FXI if we can. Take a look at China. Yep, nothing to hate about China. Hardly any pullback the last couple days. The dragon has even come out of the river. The slope has reversed and moved up. We now got above the 200 period moving average, this orange line. The 90 period regression line is this green line that is sloping up. The river is sloping up. The 30 is sloping up. The dragon is out of the river. This is very positive. Anything above 39 and a quarter, you should be piling on. That's really good. Take a look at XIV. This is the inverse of that volatility. Much like the market itself, it's had 2 days worth of pullback. But I want you to notice that it has the volatility piece is not given back anywhere near as much as the market did itself. It's not even near its or it's, I guess it's near, but it's further above its river than the S&P is, and then certainly anything north of about 29.5, and it's all systems go to the upside. I like the fact that it was able to clear this. It's basically got to get above this 29.30 price level in here and really get going. So we'll see what the market has had a weekend to digest the meaning of the Fed, and so there may be some head fakes and whatnot Monday and Tuesday, but I think this week we find out what the market really thinks about the Fed's activity. Does it come back here with some volatility to the Bollinger Band mean, or does it take off to the upside? So we're about ready to find out what that market response is. Similarly, if we looked at just the straight up VIX, that's going to look like almost a washout pattern opportunity on the downside, with 3 days of failure to fail further. And then if it breaks above 14.5, it gets to 15, and then 16, and then the upside of the river here. And then if the market likes what the Fed did, a willingness to keep printing, then the VIX will continue to fail. And it's almost ready for another reverse split here pretty soon at this rate. So we've got some really good index-based opportunities coming up this week. Let's take a look at. We looked at Brazil last week, and so I want to look at Brazil and Europe one more time. Yeah, Brazil enjoyed the week. These are the last 5 days in Brazil. Still well above its the river. The dragon is out of the river. I'd see support around here at 47, and then once it clears above 50. So you got about $3 worth of yellow zone tactical trading. And the further back it pulls, as long as it stays above 47 and resumes, the better you're going to like it, because then you can get some money in hand if it were to go through 50. Request for Google. Google's is in really good shape here. And what's attractive about Google is that it closed near the top of its trading range over those last 3 days, and at 9:05. That's very favorable. And then we'd expect, let's see, 9:10, 9:20. And then 9:30 is above 9:30. It's free and clear. That's a 3% move. But that's a very attractive chart compared to the other techs and U.S. large caps that got smoked on Friday. Let's take a look at our new favorite friend in Tesla. If you like Google, you should be loving Tesla right about now. Breakout from sideways quiet channel, taking off and not looking back. Me gusta mucho Tesla. My daughter was out in California this summer with my wife. They were visiting family, and a couple of my family members work for Elon Musk at SpaceX at the rocket. They're rocket scientists, but they work for Elon and so they got a chance to tour the Tesla facility and sit in the car. And my 14-year-old said, "Dad, you should buy some Teslas." So we bought back in here based on my daughter's recommendation, and I put some in her IRA for her. Tesla's pretty cool. Elon Musk is flat out genius. Everything he touches turns to gold. Okay, last call for any other symbols before we call tonight. I got some papers to grade and videos to record. We got to get this thing published on. I will hang this this recording on the YouTube channel as soon as it's done. It takes about an hour for it to process. If there's no other questions, then you guys take good care, and we'll see you in the chat room. Keep your powder dry and your wrist measured. And do I see Yehuda in there? No. Okay. Okay. Take care, guys, and we'll see you down range.